Well, let's go ahead and, I can take my mask off now. Hooray. Let me go ahead and get started. First of all, thanks so much for showing up today. Again, if you haven't grabbed breakfast tacos, please do so. I'm always left with a bunch of extra, and then I bring less, and then I'm still left with a ton. So take breakfast tacos with you, grab some tacos. They're here for you. Speaking of breakfast tacos, before we start talking about understanding credit and how to help your credit challenge buyers, I want to thank our breakfast sponsor for this morning, which is Snapshot Image Pros. Round of applause. Thank you for free tacos. Dave's going to come up and talk a little bit about what they do and how they can help you with your listings.
Well, I'm Dave. I'm the owner of Snapshot Image Pros. So you all know that really good photos can make a difference in your listing and sell faster and for more money. Now we have a lot of different packages, various prices. We start out at $70 for a mini shoot of 15. That's your condos, your small properties, etc., and $105 for 25 basic package, 25 photos. Now that includes blue skies and green grass, so you're not going to get penny pinched for every little addition on that too. So you'll beautiful sky no matter what the weather. I know it's beautiful right now, but we've had some really bad weather the last couple of weeks, and I've done lots of shoots during those, and it looks just like this. But those are all included. We also guarantee a 24-hour turnaround time, so we'll get you your photos back guaranteed 24 hours. I also travel a lot further than a lot of the other photo companies as well. So I travel 50 miles around the San Antonio radius. So if you have a listing down in Castroville or Floresville or up in Canyon Lake area, I'm totally willing to drive up there to make that happen. So we do twilight photography. We do virtual staging. Virtual staging is fun too. If you have an empty house and people can't quite picture how it will look with furniture, we just digitally put that in instead of having them pay hundreds and hundreds of dollars getting cheap old furniture just so they can stage it as well. It's just easier to just do it digitally these days. And item removal too, if you got some annoying things you just want out of the picture. I've done an RV out of a property. If you don't want that RV there anymore, it's only $5 per photo. And let's see what. Oh, we just started a new social media package too. This is really cool. People on the SEM team already know about this. So the $18 for a social media package will get you a Facebook post, Instagram post, but more importantly, a free website for your listing. So this will have all the photos on there, a virtual slideshow as well, and it's also a lead generator. So anyone interested in the property will fill out their info. You'll get an alert, and if they don't have a real estate agent yet, boom, you got yourself a lead and possibly a new client. So there you go. But so for the actual class today, we put together a special promo. The promo code is credit10, and it'll get you 10% off your next listing. So 25 photos under $100 with 10% off. So
we love cheap stuff.
But yeah, just pass that. And then Stephanie will get started. But thank you all for coming. Eat those tacos.
And then we've got fridge magnets and stuff.
Yeah, we got some magnets as well, and cards and all that good stuff too. Yeah.
So today we're here to talk about credit. Credit scores, what makes up a credit profile, and how you can better coach your clients or buyer clients or advise your buyer's clients before they even start the buying process. I'm always a big fan of sending folks to a lender, especially if you've got a great go-to lender who is great at putting together plans for your clients. But far too often I'm finding real estate agents who go, oh, your score is blank, cool, go pay for credit repair. And I've been doing credit repair, credit coaching for about 7 years now, and I'm finding that only 30% of folks who have a bad credit score actually need credit repair. So this can help you stand out not only as a little bit of an expert when it comes to how to get someone ready to buy, but also save them hundreds of dollars because you're not just pushing them off to somebody else to fix whatever their problems might or might not be. So let's start with the basics. Just what is credit? On a baseline level, basically credit is trust. At the end of the day, it's how trustworthy are you? When we think of credit and credit scores, we're thinking how trustworthy are you with your finances? Do you pay your bills on time? Do you stop paying your bills and now some 21-year-old kid going through college is calling you on the phone trying to collect on that debt? How trustworthy are you? The analogy that I like to use is you need to mow your lawn, you need to borrow your neighbor's lawnmower. You knock on your neighbor's door, hi, do you mind if I borrow your lawnmower? They go, yeah, sure, no problem. Take the lawnmower, you mow your lawn, you fill it back up with gas, you make sure it's nice and clean, you return it to the garage. Do you think they're going to let you borrow their lawnmower again? Yeah, probably. Because you're trustworthy with it. And that's really what credit is how trustworthy are you? And usually we're talking about how trustworthy are you based on 3 credit bureaus. So we have Experian, Equifax, and TransUnion. Those are the 3 credit bureaus that gather all your information and put together a credit report. So they're in charge of collecting information from your current creditors, your past creditors, and again, formulating and pushing it back out. They're basically data collectors at the end of the day. Folks are very afraid of these people. Folks are very afraid of these 3 people. But really all they are, like I said, just collecting information about you, what accounts you have, what accounts you don't have, how good you are at paying them, when you've been late, what your balances are, and then pushing that information back out. In terms of how they get their information, they get their information from the folks that you owe money to, the accounts that you open, the accounts that you tried to open that got denied. All of that gets pushed to 1, 2, or sometimes all 3 credit bureaus. Not everything reports the same. So they'll gather all this information from your credit cards, credit unions, car loan, student loan, payday loan. When you try to apply for that card at cons, your Shell card, everything from where you owe something, good, bad, or otherwise, and you, coffee's coming, use it to create a report that future creditors can use to evaluate your trustworthiness. Are you going to be one who borrows that lawnmower and returns it on time? Or are you going to be the one who borrows that lawnmower, keeps it for 3.5 weeks, returns it with no gas, and now they don't want to lend you anything ever again? So they do this, again, like by creating what's known as a credit report. So what's a credit report? It's kind of like your report card in terms of your trustworthiness when it comes to your finances. Some of us have better report cards than others, just like now some of us have better credit reports than others. It's going to include your current and past debts, all of your accounts, whether open or closed. So if you paid off a car note, it's still going to be on there. Your credit inquiries and bits of personal information, your name, your social security number, recent employer, last 2 years of addresses. So they'll put in all this information into an algorithm to calculate your credit score. And this is where people put all the focus on. What is my number? What is my score? What does my score have to be? What's the minimum score that I need? How do I get my score higher? It's all score, 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 score. Before we talk about the score, we're going to talk about what exists in a credit report itself. Up at the very top, you're generally going to have the consumer information. The name, any aliases, maiden name and married name. There's been a name change. Sometimes it'll have a middle initial, sometimes it won't. So we see John K. Smith, and John Smith. We see the address on 12th Street, New York, New York. We also see a previous address on Brick Street in Orange, Minnesota. We also have current employer information if available. Below that, we're going to have customer statements. So if somebody had their identity stolen, there may be a statement about that. Or there's an account in dispute, there may be a statement about that. But something that comes from John Smith, that John Smith wants everyone to know about his opinion about what's on his credit report. Below that, we're going to have a summary of information. We're going to have the accounts broken out into the different categories. So we have real estate accounts. They have their own category in your credit report. So your mortgage. Generally, rent does not report to a credit bureau because you're not really taking out a loan. They generally kick you out if you stop paying. But your mortgage will show up there. It'll show total balance, your minimum payment, how many times you've been late, if you're currently behind on your payments, all that will show there. We'll see the same thing with your revolving accounts, and we'll talk about what those are. Then they'll add in all your total accounts, which will also include collections and that sort of stuff. And then you'll generally get a little mini summary down at the bottom, and then the page will continue breaking down these accounts one by one, showing a 2-year payment history, if you have payment history for that long. And then the last page will generally be inquiry. So that's when you go to apply for something, credit, whether you get it or not. So that's what shows up on your credit report. So again, your real estate, your primary or secondary mortgages on a home. So for example, until we refied, we had 2 mortgages on our home. One was our primary, second was our TCHAC down payment assistance. Both of them showed on the credit report. Revolving credit. We're going to spend a lot of time talking about revolving credit today. Revolving credit is that type of credit that you can use, pay it off, and use it again. Credit cards. So if you have a credit card with a $2,500 limit, you go out and you spend $1,000, you're down to $1,400 that you can use. You pay $1,000, you're back up to $2,500. Installment accounts. Those are the ones that have a starting balance and an ending balance. And once that ending balance is paid, you're done. Your car loan, student loans, something where your balance doesn't fluctuate, but when you pay it off, you can't go out and use it again. So when you pay your car off, they don't go, cool, here's $24,000 to go buy another car because you paid off your first $24,000. Not quite how it works. But that's what an installment loan is. Started at the top, pay down to 0, and you're done. Other is all the things we couldn't figure out how to categorize. So other could be any sort of payday loan that reports to a credit bureau because it's not really something you can use again. It's kind of like an installment loan, but a little bit different. Something that's a loan, but with like an asterisk next to it. American Express will often show up as other because it's not a true credit card. It's basically you have 30 days to pay it off. And then the bad ones, the big baddies, are your collections. Those are the things where folks have said, cool, we trust you enough to give you some money. And they go, whoops, our bad, we probably shouldn't have done that. And they've sent it off to somebody else to try to collect on that debt that you haven't finished paying, whether it's a revolving, installment, other, or otherwise. So now the big question, credit scores. Again, this is where everybody focuses on is, how do I get my score better? What does my score need to be? Basically, score is everything that's on your credit report, mix match, and then pushed out as a number. Different credit bureaus weigh things differently. So that's why you'll see someone who has a 625 on Experian, a 605 on Equifax, and a 690 on TransUnion, just for an example. We get this a lot where they check on Credit Karma, which only shows 2 of the scores. Or they use that Experian, which only shows Experian. So getting your clients to have access to all 3 of their credit scores is really important because we know that mortgage companies take that mid score. Basically drop the high, drop the low, whatever score is left in the middle, that's what counts. So having your clients that know all 3 of their scores is really important. Again, credit scores affect your ability to borrow. Most creditors aren't going to scroll through the 23 pages of your credit report. They want to look at that number and make a determining factor based on that one single number. Again, credit scores are a pretty general term. There are hundreds of different credit scores even within the different credit bureaus. We'll use the Credit Karma example again. Well, they said that my Equifax and my TransUnion were both over 650. Why did that mortgage lender tell me that my score is only a 590? Because even within the different industries, those numbers get pushed out differently. So you may be a 650 on Credit Karma, but when you go to get a car, to buy a car, maybe you're at a 610. When you go to get a mortgage, maybe you're at a 612. There's really no rhyme or reason. Everyone goes, mortgage scores are going to be lower than anything else. Not necessarily true. So prep your clients that there are 8 different versions of your credit scores. Insurance companies will pull a different one. Department stores will pull a different one. There are multiple versions of a credit score. So don't just take Credit Karma score. It's a great tool to, are you moving in the right direction? Are you not moving in the right direction? It's not the end all be all. So credit scores, I feel like there's a lot of mystery around credit scores. Who here in the room feels like they have no idea when their score is going to go up, when it's going to go down? They know that I better not be late and I better not let them go to collections, but beyond that, it'll go up 10 points and you're like, I have no idea why, or it'll drop 10 points and you're like, I have no idea why. Anybody else feel the same way? Yeah, your clients do as well. Credit scores feel like some Harry Potter bullshit. We don't know how it works. Like there's a magic being done in the background, but I'm here to teach you today how to demystify your credit score a little bit, how to feel a little bit more in control when it comes to understanding how credit works, and to prove to you that Hogwarts has very little to do with how your score is qualified, although that would be very cool. So what makes up a credit score? Again, we talked about the things that are on your credit report, but how are those things generally weighed to come up with a credit score? We're going to start with the little numbers. So we have our 10% right here. This little 10% is types of credit. Just like anything else, variety is the spice of life. And the more different types of credit, the better your score is going to be generally. So if you have a mortgage and a car note and 3 credit cards and a student loan, they're going to go, they know how to manage different types of credit. They can be trusted not just with their car loan, but with a few different types of credit that work differently. We're going to give them a few little brownie points for that. So that's a pretty small amount of your score, but it does help. Another 10% that is new credit. We're going to use that lawnmower analogy one more time. You borrowed the lawnmower, you return it, it's great. You borrowed it a second time, you return it, it's great. By the time you borrowed it, time number 10, your neighbor's just leaving his garage open for you to go and help yourself. That first time, okay, they did a good job, but are they going to be able to do it a second time? And that's where that new credit comes in. It's really a combination of the length of credit history and what's new. Also, what falls into new credit is your inquiries. Where inquiries come from is you applying for credit. There's a little bit of a hesitation when it comes to your credit score. If you're applying for a bunch of new credit and a bunch of different credit, that might mean you can't afford to handle your day-to-day with what you have. So if you're applying for a gas card and you're going to Rooms to Go and you're applying for a Rooms to Go card and you go to Home Depot and you apply for a Home Depot card and then you go to apply for a consolidation loan, you're like, this person is in dire straits. Why are they asking for so much money? So that's a lot of what new credit is keeping those inquiries low. Coach your clients, don't go apply for new credit right now. I know you want to buy a bunch of stuff, but now is not the time. Jessica.
Well, what about when someone puts you as authorized user, like just yesterday?
Mm-hmm.
So would that be under the new credit as well?
So we'll talk about that.
Okay.
Moving down to that 15% is length of credit history, and this is where we're going to talk about that. So we talked about you don't want a bunch of new stuff, and again, the more time you have with accounts in good standing, the better it's going to be. Jessica asked about being added as an authorized user on a card. My sister-in-law is looking to buy a house. I'm not going to call her out, but she's looking to buy a house. If you meet her, she's a very lovely lady. Don't tell her what I told you. She's looking to buy a house, but her credit is a struggle. So what my husband and I did is we added her on to our credit card that we had 10 years of good history on. So now my sister-in-law benefits from that length of history. So does that answer your question on adding that on? Basically take the average age of all of your accounts. If you've got one that's 1 year, 1 year that's 10 years, then they say you have a 5-year credit history. The longer it is, the more little brownie points you're going to get to help boost your score. Let's move down to this 35%. We'll talk about this here in a moment. But this 35%, this big old green chunk right there, that's your payment history. If you've ever been late on a payment, I've done it, no shade. You notice that that first month, you're like, I was 2 days late and my score dropped 40 points. Yeah, because it's over a third of what calculates your credit score. The best thing your buyers can do to raise their score is just pay their damn bills on time. The good news is, the further away you are from that payment mistake, the less it hurts your score. Lawnmower. Maybe the third time you use it, you forget to return it, and you go on vacation. God damn it, I wish I had my lawnmower back. But time 4, you return it on time. Time 5, you're going to rebuild that trust. And so your payment history is very much the same thing. But if you have clients who are consistently late, they're just falling down this mountain. There's just this pushing that boulder up and just continually falling further and further behind. So the best thing that anybody can do to help their credit score is just pay bills on time. And it seems so basic, but when you think about what is credit, credit is trust. It makes sense that it's the most impactful thing. We're going to talk now about this big blue chunk down at the bottom. I wanted to save this for last. This is your amounts owed, and that's a little bit of a misnomer. What we're talking about down here is your revolving credit, your credit cards. How much of your available credit are you using? So if you got $5,000 in available credit and you're using 4,900 of it, it's going to hurt your score more than if you have $5,000 of available credit and you're using $10 of it. So no, this little 10%, sometimes that's hard for our clients to manage or to get them points fast, because that's the variation of the credit that they have. Well, I don't have a car note. We're not going to tell them to go buy a car, to just have a car. This new credit, they may have already gone out and applied for a bunch of stuff, or maybe they just got their car 3 months ago. And so now their score is just kind of right in the middle. We can't go back and reverse time and make those accounts older. Same thing with the length of credit history. But that payment history and the amount owed, good news is that's well within our client's control. We don't have to reverse the clock necessarily. We just have to make good choices going forward. So it's a good thing that's 65% of what affects their credit score. So we get those clients who go, I don't have any collections. I pay cash for everything. Why is my score 510? Well, that's why. Your credit score is the balance of your good credit versus your bad credit. So if someone has 10 accounts in good standing, but they kind of messed up and have 5 items in collections, they're probably still going to have a really good credit score. If someone has nothing in collections, but has no good credit, there's no variation between the two, and so they're going to sit with that low score. So what can folks do to have good credit or to build credit or have something on their profile? So paying back loans on time, having credit cards with a low balance, accounts with a long history. The examples of bad credit, you're missing for late payments, items in collections, multiple credit inquiries, those only stay on your report for 2 years. So we're going to talk about revolving credit quite a bit today. This is the magic bullet when it comes to getting points for your clients fast. If I have a client who comes to me, or a buyer hopeful who comes to me and says, yeah, we're looking to buy a house. I just pulled my score from Credit Karma or whatever. My score is a 592. Cool. Do you have any open credit cards that you're still paying on? Yeah, we've got 3 maxed out cards and one's I'm almost done paying for it. I'm like, thank you. Hallelujah. Because we can work with that. Again, revolving credit, 30% of what makes up their scores. They told me they had 3 maxed out cards, one that they're almost paying down, so they're probably sitting with 75% of their available credit being used. So revolving credit is credit that automatically renews when it's paid off. And you use it, you pay it off, you get to use it again. When you use your cards, you have less available credit. When you pay it down, you have more available credit. That number, that ratio is expressed as what's known as utilization. So you may hear your lenders throw out, yeah, their credit utilization or their revolving credit utilization is 52%. Or you'll see it if you check your score on something like Credit Karma or CreditWise or any of those third-party apps, it'll give you a percentage. So they have a $5,000 total credit limit, they're using $2,500, they're sitting at a 50% utilization. Real easy math to figure out. What is a good utilization to have? And is lower generally better? Generally it is. The lower your utilization, the more it's going to help your credit score. So that buyer with a 592 score telling me that they're 75% maxed out on their revolving credit, probably have them pay down half of it and they're good to go within 30 days. That's why when you have someone who needs help with their credit, that first question, cool, revolving credit. What do you have that you can pay down? Not a car loan, not a student loan, don't pay extra on that. But your revolving credit, what do you have that you can pay down? I put a little chart up here. Again, this is just a sample. But I kind of know that if I have someone with a 550 score and they go, all my cards are maxed out, pandemic did me dirty, I've been living off of credit for the last 8-9 months, that I can get them 100 points if they just pay down half of their cards, generally. Again, this is just a guideline. Do not quote me on these exact numbers. But generally, I know I can get them somewhere between 50 to 100 points if they just pay down half of their credit card balance. Notice that it continues to trend upwards. Kind of every 10% or so, we see a nice big jump until we get to 1%. And then if they pay them off completely, your score drops. And for most folks, that feels terribly counterintuitive. I don't owe nobody any money. Why am I getting penalized for it? We'll have that lawnmower analogy one more time. You knock on your neighbor's door, and you go, can I borrow your lawnmower? And they say, sure, no problem. And you go, cool, thanks. One, they're going to think you're weird. Two, you haven't really built any trust because you haven't tested the waters. Credit reports only look at what's gone on the last 30 days. So if it's paid down to zero, and then down to zero, and then down to zero, it looks like you're not using this available credit at all, which can be a good thing. But they can't go, well, do they know how to manage it? Are they not using it because they're too scared to? Because they're afraid that if they use it, they're not going to be able to pay it? We don't know. Here, we know, yeah, you use it, you pay it, you're making at least one payment a month. You're keeping it in this range here. We know your trustworthiness. Here, it's kind of a question mark. It's kind of like anything prior to 30 days is completely forgotten. So if you've got clients who have credit card balances, go put your Netflix subscription on it and then pay down half of that each and every month. Use it like a gas card, leave $10 on it. Don't pay it down to zero because it'll actually negatively impact their score. Again, it feels so weird. Even me explaining it, it still feels weird to me, but that's just how it works. The other thing that could happen if you consistently leave a card at zero is the credit card company could close your account. They're not using it. Using our bandwidth to manage this account number and make sure that they're still around. Screw it. They're not using it. They're not going to notice it. Let's close it. We talked about your length of your credit history. Once the account is closed, you lose all that history. So it doesn't go, well, they have this card for 10 years, so we're still going to give them credit for 10 years of it. It goes, nope, never happened. So making sure that they're using it a little bit every month to keep some activity on it will also keep it from getting closed out by the creditor.
Would you be closer if you don't use a credit card?
Yes.
How many years?
I've seen as little as 6 months. I've seen as long as 2 years. So I'd rather just hedge my bet and go, use it for something that you're going to pay for anyway, that you're used to paying for anyway, like your gas card, Netflix, your gym membership, whatever it is that you know that you're going to be paying for. And so that way there's always some activity and at least one payment each and every month. The other thing, or the third thing about having a little bit of balance, we talked about good credit versus bad credit. One of the things that good credit gives you, or that can earn you good credit, is paying your bills on time. Think of paying a bill on time as like earning a gold star back in kindergarten. Each time you make a payment on time, you earn a gold star. If your balance is zero, you stop earning the ability to earn gold stars because you're not making payments. So anything that'll trigger, like even if it's a $5 payment each and every month, gold star, gold star, gold star, gold star. So they'll get the benefit of the low balance and they'll get the benefit of those gold star points for making those payments. But yeah, I would recommend at least one thing a month or every other month, something to just prevent it from getting closed. So some tips for paying down in terms of utilization if you've got someone who has multiple credit cards. I've got 5 cards, this one I owe this one I owe this one I owe this, I have Fingerhut that's 30% interest and all this crazy stuff. Here's some advice to give them. Pay off the highest interest rate card first. So someone who has one of those Fingerhut memberships to order things from that catalog, they're generally rolling with a 28 to 32% interest rate. That's bananas. That means that if they're paying their minimum balance, they owe this, they make a payment, interest tax back on, and they're maintaining that same balance, could be for years. So if they've got extra money, don't pay off that Capital One card that has that 5% introductory interest rate. Make your minimum payment. You've got to pay things on time. We've got to get those gold stars. Put your extra money towards the highest interest rate thing first. It'll save you money in the long run and help you pay down those other cards that much more quickly. Next, work to pay down those with the highest minimum payment. Usually this will reduce your minimum payment as the balance decreases. So for example, I have a Capital One credit card. I think it's like a $2,500 limit. When I'm close to max out, my minimum payment is about $110. When I owe $1,000, my minimum payment is like $40. So it'll help to reduce that minimum payment. The other thing that'll help, if that goes down, their DTI is better. Debt to income ratio is based off of minimum monthly payment. So if we can get those minimum payments reduced, it's going to help them on both fronts. If you have two cards that have the same interest rate, same minimum payment, how they figured that out, who knows? But however they managed to do it, we want them to pay down the one with the higher utilization. So let's say they have one card that has a $500 limit and they're using $250 and it's a $25 minimum payment. Then they've got a $1,000 card, they're using $700 of it and it's also a $25 minimum payment. I want them to pay off that larger one, not because it's larger, but because they're using a bigger chunk of it. We also see not only as your total utilization goes down, you kind of get a few little bumps and points with any one card being below a certain amount. So if you've got a bunch of maxed out cards, cool, pay them all down to 75. Pay them all down to 50%. Pay them all down to 25%. Don't focus on just one and then that next one. And then above all, never miss a payment on a card. Did I mention never miss a payment? Again, we saw 35% of that credit score is payments. So I tell folks, if you've got extra money, I don't care if it's an extra $10, put it towards that credit card that you all want. But if you think that $10 is going to make you miss a payment on something else, don't pay extra. Paying on time, the most important thing that they can do, making those payments on time. Then we have those folks who are, I have no debt. I also have no credit. I've never had a credit card in my life. My car was gifted from a family member, a hand-me-down. I have nothing on my credit profile. How do we get them started? Again, if that balance is owed, that revolving credit is 30% of what can constitute their credit score. We want them to have the ability to earn those gold stars for making payments on time. A secured card is going to be their best friend. Generally, you can do a secured card with a $200 security deposit. It reports to the credit bureaus just like a regular credit card does. It doesn't go Visa, but it's secured. No, it's a Visa card, just like anybody else's Visa card. To maximize their score, we advise $300 minimum balance. It just seems to report more points more quickly. But if all they can do is 200 and that's the difference between them building their credit or not, let's get them building their credit. Most banks, most financial institutions will offer some sort of secured card. Your big banks, your Bank of America, Wells Fargo. If you Google secured card, you're going to come up with 500 different options. I think Capital One has a secured card as well. But again, you treat it just like a regular credit card, which means those utilization rules apply. If they have a maxed out secured card, they have a maxed out regular card, then we need to get those balances down. So again, if the secure card, once you get it, put your Netflix subscription on it. Make sure that you make at least one payment each and every month. Don't pay it off completely. Always leave $2 to $5 on there, and we're going to watch your score climb. Again, remember that your credit score is the balance between your good credit and your bad credit. So if they continue to maintain no bad credit each month that they make a payment, that low utilization, they make a payment, and so on and so forth. We've got to keep this floor looking good, so that way that good credit compensates for that being their only account. If they can do 2 secured cards, great, because we're talking about variability of those accounts as well. So notice, we'll stop here for just a second. So we talked about utilization. Got open credit cards? Awesome. You want to get pre-qualified in about 25 to 35 days? Awesome. Can you make a payment tomorrow, like a big payment? You've been saving up for your down payment? Cool. Well, you don't even get to use that down payment until your score is good. So why don't we take 1,000 of that and pay down that credit card that's maxed out, and now you save yourself on interest, and now we can get you approved. We talked about, I don't have any credit, or all I have is maybe one collection and a student loan that I'm paying $10 on. Cool, let's add another good account to help boost your score. Notice I never mentioned the word credit repair. You're going to get a lot more of these folks than the ones who will truly benefit from credit repair. And even the ones who maybe have a collection. Again, variation of good credit versus bad credit. So maybe their bad credit is here, but if we can do enough good things, this doesn't matter anymore. because you have so much good that you might as well forget about this. So this is why we shouldn't be pushing our clients off to folks charging $100, $200 a month, $100 setup fee, $200 setup fee for 3, 6 months. They might not need it. Someone who has a bunch of credit card debt, what do they need to repair? The only thing they need to repair is paying on that debt. The person who has no credit, what are we there to repair? There literally nothing exists. So before you go, let me get you to my credit repair specialist, or I know a good credit repair person. Check these things first. Do your clients a favor. We know that if they pay down those bills, we're talking what, 25 to 35 days. You just need that payment to report to the credit bureaus. It's a lot quicker and a lot easier than paying $600 or $500 or $250 for credit repair that may or may not work. But there are times that credit repair is valuable. So we'll talk about credit repair. Most of us have collections on our account. I'm not going to ask you to admit it, but 32% of people who have some sort of credit file have at least one collection on their report. I'll bite the bullet. I'll take the blame for 1 out of 3 of y'all. Yeah, I guarantee we've got 12. So there's at least 4 or 5 of y'all that have at least one collection. And we're realtors, so we probably have more than that. But a third of people have at least one like major derogatory on their credit report. No shade. It's common. And the more that we can let our clients know, hey, totally relatable. You're in really good company. You're the same as a third of the people in this nation. But we're going to fix that. Collections, negative items, judgments, sometimes bankruptcies, repossessions, all that sort of stuff can generally be mitigated with credit repair. So for credit repair, or let's talk about kind of how things come off of your credit report before we talk about credit repair. So a negative item will stay on a credit report for 7 years. So if somebody had something to go into collections today, we'll see you in 2028. If they did something bad back in 2015, cool, what month is it? You did that in October? Cool. 4 months, it's like it never happened. So we also want to take a look at when they do have collections, it's something that's naturally going to fall off soon anyway. So if folks need stuff removed, they can either wait for that 7 years or get a credit specialist or a credit repair person to help get that removed. So when we say getting something removed with a dispute, I'm going to put giant air quotes around dispute. Generally, credit repair folks, at least like when I've done credit repair for folks, it's not really disputing the debt. We're not going, no, that's not mine, or no, that didn't happen. What we're doing when we talk about disputes is we are asking the credit bureaus, so Equifax, Experian, and TransUnion, to go prove it. It's that innocent until proven guilty. So we use what's generally known as a debt validation letter, and it's, hi, my name is John K. Smith. I'm asking you to verify the validity of these following accounts. That's simply what it is. I'm going to tell you right now, as someone who does credit repair, it's a crapshoot. And I'll talk to you about why and when some things are easier to remove than others. But basically, once those credit bureaus, or it can also be sent to the original debtors, they have 30 days to go, yep, this is yours, and all the information on it is correct. If they can't do that within 30 days, legally, it has to be removed from that person's credit report. So let's talk about how this might work. I used to work for a collection agency. It is the worst job in the whole wide world. So if somebody calls you on your debt, be really nice to them because they're nice people on the other end. But here's how collection agencies work. So let's say you had a cell phone with AT&T, and you stop paying your bill, and they shut off your phone, and you're like, forget it. I'm just going to go to T-Mobile and open up a new account. AT&T is going to try to collect on that debt. They're going to call you, hi, this is Suzanne with AT&T. Did you know you didn't pay your bill? And you're like, I don't know what you're talking about. But AT&T is going to try for a certain amount of time, and they're going to sell your debt to collection agency A for, I don't know, maybe 50 cents on the dollar. You owe AT&T $500. Collection agency says, I'll pay $250 to try to collect on that $500, try to double our money. We'll give it a go. Collection agency A, hi, this is Suzanne from collection agency A. Yes, I used to work at AT&T, and I'm still trying to collect your debt. And you're like, I don't know. Maybe they'll try for 6 months, a year, 2 years, who knows? Then they go, well, we paid $250 for that debt. We're not getting anywhere. We want some of our money back. So they sell it to collection agency B for maybe 25 cents on the dollar. And then collection agency B tries to collect, and you're real good at dodging calls, and it continues down to where you get, and the company like I used to work for, where we're just calling, trying to collect whatever we can. Just grab. We pay pennies for that debt. It becomes kind of like a game of telephone. So if you ever played telephone as a kid, or your kids played telephone, when we have that first person, they know exactly what that word is or that sentence is. By the time you get to kid number 10, they have no idea what kid number 1 was trying to say. And it works very much the same way when we're talking about debt getting sold. So the accounts that are easiest to remove are the ones that have ended up down here. Because AT&T has said, it's this. Agency A said, cool, awesome. Sell it to agency B, and maybe they misspelled your first name, or the date is incorrect, or a decimal place cut, and then so on and so forth. They're literally just sending just data. That's all it is. Like over-glorified Excel spreadsheets. So the older your debt is, or the more it's been transferred from account to agency to company, generally those are the ones we have the most success with removing. So if you have someone who has a bunch of debt and it's like, hey, we just stopped paying our bills 3 months ago, it's going to be really hard for a collection or for a credit repair company to get that removed because it's still with that original person. Question.
Does the 7 years start over every single time they sell it?
Sometimes it can. And generally we like when that happens if we're doing credit repair because that's not correct information. They go original date opened is October 2019, and then it gets sold and they go, nope, it's May 2021. We're like, no, it isn't. Prove it. And they go, sure, we can. Cool. Delete it. That's a very good question. If the info don't fit, you must acquit. So what are we talking about with info? We're talking your personal info, your name, your date of birth, your address. So my birthday is October 18th, 1978. If I had something on my credit report that says her birthday is October 10th, 1978, sorry, that must be a different stepping stone. I don't know who that is. And people go like, oh, you're trying to be sneaky. But if this is the barrier between someone getting approved or not getting approved, let's at least go for it. The original creditor, sometimes when you see sold to collection agency A, B, and C, sometimes collection agency C will go, the original creditor was collection agency A. No, it was AT&T. Prove to me that creditor A or collection agency A gave you money. They didn't. You got to remove it. Date open, date of last activity, we talked about that. And then, of course, your current balance. There can be a bunch of other things in there that need to be verified, but these are the most common things. Then we get those folks who are like, look, I know I didn't pay my AT&T bill, but it's just $250. What if I just pay it and then we're good, right? No. Once something has hit collections, the damage is done. So if you pay it off, they just go, cool, you have a paid collection, but it's still a collection. So I tell folks, unless your mortgage officer tells you to pay something off, do not pay this off. The other thing that can often happen, just like you brought up, they'll restart that date. They'll go date of last activity, May 2021, and then we've lost a little bit of length of history, or it's added to that new account thing that tends to drop the credit score. So I don't care if it's I owe $3, why don't I just pay that $3? Cool, you could owe $3 million. It affects your credit score the exact same. A collection is a collection is a collection is a collection. The amount doesn't matter. What matters is how long ago it was and the original open date, basically. But why? Again, age is tied to the date of last activity, so we don't want any activity on that account. The more recent the activity, the more that it's going to hurt your score. The older the account, again, the less it hurts your score. We just want it to age out. You know, time forgives all sins. Same is true when it comes to your credit score. Yeah, when a collection is paid, you just have a paid collection on your report. The account isn't deleted. If you have a buyer who says, well, I called them and I asked them, like, well, if I pay it, will you delete it? And someone on the end goes, sure, yeah, totally. Make sure they get it in writing. Again, used to work in collections, you work on commission, terrible job. You don't make a whole lot of money, so sometimes, in desperate times, just say, yeah, sure, I'll see what I can make happen just to get them to pay it, because that's your paycheck. So, not to say that everybody who's in collections is shady, but sometimes you kind of overpromise and underdeliver. But if you have something in writing, then that's something to be sent to 3 credit bureaus to go, well, they said that they would delete it, they haven't yet, please delete this from my credit report. If it's not in writing, just like real estate contracts, if it's not in writing, it never happened. Make sure your clients know not to fall for somebody going, yeah, sure, yeah, we'll delete it. Because generally the person on the phone can't authorize that anyway. And again, the damage is done. Like a bruise, just let it fade over time. So let's go, any questions, anything that you wanted to go over again? And we're gonna practice on some kind of fake credit profiles and see what advice y'all would get. Jessica, and I'll come back.
So when you were talking about those are, at the end, that's like the settlement accounts.
Mm-hmm.
You were saying like, if they ask you for a settlement, ask for that deletion letter or whatever.
Yeah. So yeah, basically, if it's already in collections, unless they're going to delete it, leave it alone. Unless the mortgage officer tells you to do so, and that's only for DTI, not for credit score. But even if they go, what we could settle it for 10 cents on the dollar, cool. Now you have a paid settlement, which is a paid collection, which is no different. Yeah, no payment arrangements. Payment arrangements are the worst because every time you make a payment, your date resets and resets and resets. Any question in the back?
So I've come across a lot of prospects that have like broken leases from apartments from when they were younger, but, or I mean, 4 years back, 3 years back. Is that something that you would just generally not touch?
Yeah, it's a collection like anything else. So treat it as if it was their AT&T bill.
So there's no difference that it's like the real estate kind of?
No. The only time it would make any difference is if they're trying to rent again. But when you're applying for a mortgage, they go, well, this is real estate related, so we're gonna, do a big red X. Yeah, it's all the same. I had someone in chat on YouTube ask about medical bills. For purposes, depending on what loan program someone is doing, generally it doesn't count towards your DTI. That has nothing to do with the credit score. So medical bills are the exact same thing. If you have a medical collection, same as a broken lease. It's the same as your AT&T bill. It's the same as a repossession. The type of account doesn't really matter. What you bought with it doesn't really matter. It follows the same rules of let it get older, don't touch it, don't set any sort of settlement agreement, payment arrangement, anything like that until your mortgage company tells you to do so.
How about if somebody's in forbearance? Is that going to take like a negative impact onto the credit report or be down as collections?
Generally, forbearances don't, because that's a separate arrangement. They basically made like a payment arrangement with the mortgage company, or we're still gonna charge you, but we're not gonna try to collect on that payment until like it's in like a student loan that's in deferment, very similar for our concept. But it shouldn't show up as a collection if it's in forbearance. Now, if they go, cool, your forbearance is expired, where's our $11,000? And they're like, we don't have it. That's something that could go on there. Same with like a foreclosure. Foreclosure would be the one real estate thing that's weighed a little bit different when it comes to mortgages. Depending on the loan program, they want to see a certain amount of time before that, or since that foreclosure, in order for you to qualify, and doubly, triply so if you got foreclosed on a VA loan. Save up money, go conventional. Any other questions that we have before we do a little practice?
What are your top secured cards that you do recommend?
I like Capital One. There is, was it Premier One? Like Premier One, I haven't seen anybody get denied for it. Some of the big banks like Bank of America, Wells Fargo, they can still deny on a secured card, which seems weird. But generally, I'm not one to go, just Google it and pick the one that shows up as like a paid ad. But generally, those are the ones that are going to be guaranteed approval. And if you've got someone, shoot me an email, and I've got like a link to a couple of that I can send over to you. Cool. Let's see, I have one more question. Yeah, cool, medical bill. So let's do a little bit of practice. Again, this, if you want to jot this down or take a quick photo, but it's the points to remember. But basically, don't be late on your bills. Keep your credit cards low, but not zero. Don't open new stuff. If it's in collections, don't touch it until the person in charge of your loan tells you to do so. And then if they've done all of those things, they paid down their credit cards, they're not opening up anything new, they've opened up that secure card. Generally, we see about maybe 3 months before we want to read full credit. If they've done all that, then that's when you know credit repair is probably the best solution for them. We've tried all the easy stuff, and we're still not getting where we need to go. Cool. Let's do a little practice as a group. I'm going to give you 3 just little summaries on a credit profile, and I want folks to shout out a piece of advice that they would give that person. So let's start with person 1. So they owe $3,700 total on their credit cards. Their total credit limit is $5,800 if they've paid everything down. They have 3 collections. One is from 2015, one from 2018, one from 2019, and they have a credit score of 592. What would you advise if that person is like, what do I need to do to get above a 592? What is the first thing that you would advise them to do?
Pay your credit card.
Awesome. They asked about those collections. Cool. In fact, that one from 2015, depending on what month it is probably pretty close to falling off their credit report anyway. Even if they just let their account age, I don't know, 3-4 months, they're going to see an increase in their score. So we know that they're at a 592 based on that chart. They pay down half of their cards, they're probably going to be sitting at a 650. Not too bad for 30-day turnaround. Yeah. So their utilization is currently at 63.7%. One of those collections hit 7 years and should fall off. So I advise them, if you pay $2,000 on one of your cards, a couple of your cards, split it up however you want, and then we should see a 35 to 70 point jump once that payment reports. Person number 2, they have a car loan that they've had for 7 months. They haven't been late, so good for them. Nothing in collections. Their last late payment was on their previous car loan 10 months ago, and they're sitting at a 588. Love it. Secure card. Because all they have is that car loan. Remember, we get a little bit of bonus with variety. We get a little bit of bonus with available credit. Secure card. Great job. So we want them to keep paying their car on time, of course. Don't be late. Not even a day, not even an hour. Over time, that will continue to increase their score. And then add that secured card or any other credit building account that they have. Or if they have a really nice mom or auntie or sister-in-law and brother that will add them onto something with some age, that's another option as well. This might take 3 to 6 months to get them where they need to go from a 588 maybe to like a 620, but that's a lot better than them just spinning their wheels for the next year. Good question?
I have a question. I've been seeing where, I guess, okay, to be honest, I saw it on TikTok.
Cool.
But
It's like some kids like dabbing at the end? Okay.
so it's somebody who does like credit repair, right? But they're saying like if you have a car loan, do a 15-3 like trick. Do you know or have you heard of that, or is it? I wanted to personally try it myself just to see like, okay, does this work? Like, is it something I could advise to my clients? You know?
I would. It can in the same way that like credit repair can, but if they're already at this point where like we want to figure out how to buy a car and we're thinking about or how to buy a house, we're thinking about all this stuff and we need to figure out how to continue to build our credit and all that sort of stuff. I'd rather not complicate things. So it can work, but also it might not. And if their lease is up in 5 months, I don't want to go, let's try this for 3 months. Oh, it didn't work. I'd rather go with something that I know is going to work. So it might be a thing of like, be a good thing to try in addition to this, but I wouldn't rely on that sort of hack as the only solution.
And what if you're like a new or high school kid who just came out and he has a secure card, 7-something credit, but that's it. And would you advise him to get a loan? I mean, a car loan for a house, or get another type of card, or get an ads with a credit card?
Yeah. So I mean, here's the thing: if he's already sitting with a 7 whatever, why are we adding more debt or the opportunity for more debt? We don't need to increase anything. So you have someone who's like, yeah. So if you're like, he has one card and we can't seem to get him over a 550, cool. Then what can we do? But basically when you're looking to get approved for something, whether it's a house, a car, whatever, I don't care. Your credit score is kind of like paying your cover. You got the money to pay your cover, you're good. And then once you get in, you get, judged with everything else. But if he's already at a 700 credit score, they're going to let him through those velvet ropes. Doesn't matter what's on there or what isn't on there. The best thing for him is just, keep that credit card low just for PTI purposes. Yeah, definitely. Unless he needs to buy a car, cool. Then, I'm not going to tell somebody not to buy a car that they need. But if he doesn't need it, it's just cool. Here's another bill that I have to pay that I didn't have to pay last month. And then our final one for today. So this person has one card at a 22% utilization. They have another card at a 15% utilization. They have 5 collections, the most recent being 4.5 months ago. Their most recent late payment on an open account was 6 months ago, and they're rolling with a 542. You just don't qualify. Just kidding. Sorry, yeah. Sorry, goodbye. Come back to me when you're better.
Pay the first one off first.
Okay, so paying down that 22%, cool. Yeah, pay the second one down. That'll get them a few points. There's not a huge jump between 15% and 1%, but if they're at a 542, if that little 12-point jump that they would get is the thing that pushes them over, sure, let's do it.
So, question, I know we're not all the way through it, but about how long would it take for a situation like this to get resolved to where they could get through, potentially?
It'll depend, and I'll answer that question when we kind of go over the answer. Just want to see the answer. Anyone else want to shout anything else? So, number 1, no more late payments. Continue to pay on cards. This is where I would go, man, your utilization is low. You could pay them both down to 1%, but that's going to get you maybe to a 570 if we're lucky. We're still not there. Or we just go, cool, just continue to pay on time and let's check next year or 18 months from now. So again, if this is someone that we know the things that we have, we don't need to get him another card. He has 2 cards that he's able to manage. We don't need to necessarily build another account. We just need him to not be late on anything ever again. And then in the meantime, what can we do to maybe take off a couple of those collections? Help to boost that score a little bit. This would be someone who I would go, like it's a Hail Mary pass, but it's either we just wait for your last late payment to be 24 months ago, or let's give it a go for a couple months and see how it works. The last thing I'm going to say in terms of credit repair, since we're talking about someone who would be a credit repair candidate, generally, someone who goes under credit repair is going to see the biggest result within the first 45 to 90 days. It's kind of like when you go on a diet, you lose like the 10 pounds that first week, and then like week 2, you're like, I lost a half pound, like what's going on? It's just kind of regulating. With credit repair, it's that low-hanging fruit that tends to fall off. If it didn't get removed in the first one, in the first round of validation, why is it going to get removed in the 3rd one, or the 8th one, or the 10th one? I've got folks that are like, yeah, we've been doing credit repair with big name credit repair company for 7 months. Why? What's going to change month 7 that didn't happen at month 3? So I tell folks, like, do credit. If you're going to do credit repair, no more than 90 days should they be paying for it, and maybe pause, reevaluate. Because if there's no change within that 90 days, nothing magical is going to happen at day 120. Yes?
I'm not sure if somebody already asked this, but when a collections account is removed, does your score jump up a little bit?
It will, because it's like that collection never happened. AT&T, who's AT&T? We don't know no AT&T. They were never here. You never had an account with them. It's literally like it never happened. That is the closest we get to reversing time.
I have a question. When a lender stipulates, like, for the buyer to pay off a collections account, they don't necessarily tell them, like, oh, get a letter of purgation.
Mm-hmm.
Is that, like, common, or is it best for the client to still ask for a paid per deletion?
They might as well ask, couldn't hurt. Generally, if a lender is asking for someone to pay off something that's in a collection, it's for DTI. Because the way that works with most lenders is they take your collection amount, if it's FHA, they don't worry about medical, and then they take 5% and they go, well, that's what we would estimate a minimum monthly payment on your collections would be. So sometimes we'll just need to reduce that monthly payment to get their DTI reduced. A really good question. Anything else from you before we wrap up? Yes, Jessica.
What about for those buyers that their spouses, male or female, they don't have an employment, they don't have a job or anything, they're taking care of kids? What would you suggest for them? Like, just for them to get a secure card so they can have some type of credit? They don't have, let's just say they don't have credit.
Yeah. So if we're talking specifically the purpose of buying a house, if we're not counting their income, we're also not counting their credit score. So I don't care if it's I stay home with the kids or, you know, my wife makes all the money and, you know, I just help around the house, whatever. I don't care if you have a 305 credit score. We don't need to count your income. We don't need to count your score. Texas is a community property state, so we do have to count their debt in terms of DTI. So it might be worth to pay down something, but we never need to build up somebody's score or add additional accounts to someone if we're not counting their income, whether they have a job or not.
So they could still be on the mortgage even though they don't really have any income?
Yeah, so they would still be on the deed, but not, they would be like a non-purchasing spouse. We did that. I think we left me off of the loan when we bought our house so that we could qualify for down payment assistance because we made too much combined. So I was like, cool, don't count my income. He's got enough. Credit's good. My debt's low. All I had was one car payment. So it doesn't even have to be someone that we don't count because they don't have a job. If it just makes more sense to not put them on the loan for whatever reason, then then we don't worry about credit score. Just what it does to DTI. Alma on YouTube asked, can a person correct a late payment? Sometimes credit repair can help remove a late payment. Don't count it, put it that way. If it happens, great, but there's maybe 10-15% chance that when that gets, there's a couple ways that can be done. There's what's known as a goodwill letter that's been like, look guys, I've paid this bill on time for the last 3 years. I know I missed one like 4 months ago. Oops, my bad. Would you do me a solid and like remove that from my credit report? Sometimes that works. But if it's something where like you've been habitually late, sometimes we can go like, hey, can you prove when this payment was received? Can you prove like all this sort of stuff? And they'll generally go, yeah, here it is. And it's worth a shot, but don't count it. Really good questions. Any other questions from YouTube before we close out? Do we feel like oh yeah, go ahead.
I have a gentleman that I'm working with. So he said that he had about 8,000 that were habitually paid late on. So his credit was just kind of ruined at the moment. And he went and paid them all off, and now it's building back up. I think it went up about 120 points.
Yeah.
Within the past 6 months or something like that. And so he's asking now so that would just be like replacing those missed late payments and no debt now with like another secured credit.
Yeah, well, I mean, if those accounts are things that can remain, so what kind of accounts are they? Were they credit card or car loan or?
He's got 2 credit cards, a car loan, or car loan, or something like that that he possessed. So he completely got rid of everything. He has nothing on like cash.
Are those credit card accounts still open?
No.
Shouldn't have done that. So if you keep earning points by earning gold stars by making payments, it's like, I don't have anything to pay, no more gold stars for me. It's basically kind of gotten as good as it's going to get, other than just the benefit of time and those past mistakes getting older and older. And that's probably where most of his points came from, is just, it's been a year since he was late. It's been 11 months, 12 months. And once you get over that first year, so basically if you miss a payment, your score does this. And then it sort of like starts to correct slowly, and it becomes exponential. So then it does this, and then it does this, and then it does this, and then it does this. So if you lose 50 points after that first month, you may gain 5 back month 2. And then you'll gain an additional 10 month 3, maybe additional 15 month 4. So a lot of that is that benefit of time that is getting older. And then once you get to about 2 years, there's still a little bit of an impact, but pretty negligible.
Yeah, 'cause I know he was just like fed up with it. He was like, I don't want anything to do with credit cards ever again. So he closed out all the accounts. So.
Yeah. So that's the other thing. If you ever have somebody, just a little piece of advice, who goes, I'm going to reach out to a debt consolidation company. Stop them. The way that those work is, cool, we're going to negotiate on your behalf for the debt that you have, and we're going to close them all. So that credit card that you had for 10 years that you're struggling to make that payment on, it's gone. So I've seen a lot of folks who pay off their debt and their score drops 45, 50, 60 points because they have
balance transfer.
Balance transfers are totally fine. If balance transfer makes sense because you're getting 2 things. You're getting an additional line of credit that will help that utilization, and 2, if it's saving on that interest, then great. And the only people who can do balance transfers, though, are folks who have good credit anyway. Very rarely someone with a 550 gets a letter from whatever credit card company offering a 0 interest balance transfer.
Stephanie, what if you refinance a car like to a lower interest rate? So you have to get a new loan, but you're paying off the other loan. How does that affect it?
There's a lot that would go into it because it depends on, cool, what else is on the credit profile. If that's the only thing, and if they can refi, that means their credit score is probably pretty good, so we're probably not worried about this.
Usually for that, like I'll have the lender kind of make that decision if
Yeah.
they recommend it.
Yeah.
Just because I'm like,
Yeah, if there's anything about like where we're trying to get like funky with somebody's credit, basically if someone's trying to buy a house, don't do anything with your credit other than pay your bills and pay your credit cards down. Don't do anything unless the lender specifically asks for it. It's like, hey, I want to refi my car. If that's the solution because their DTI is 55% because they have an $800 car payment, cool, then that's the solution. But if they're still at a 33% DTI, why are we futzing things up? Like kind of a, if it ain't broke, don't fix it sort of situation. Cool. Do we all feel like we kind of understand credit a little bit better, whether it's ours or our clients? Awesome. Feel like we can give at least a little bit of preliminary advice. Stop having people pay for credit repair if they don't need it or not paying for it until they need it. But yeah, I mean, if you subscribe to us on YouTube, it's youtube.com/thestoneteam. This whole thing has been recorded. We've been broadcasting live, and so it'll be up there in about 2 hours. So if you're like, where's that chart that has like how many points potentially they could earn, or what is revolving credit again, you can come back and rewatch the broadcast. But any other questions before we shut down? Awesome. Well, thank you all so much for showing up today. Don't forget to grab, thank you. Don't forget to grab your coupons and your magnets and stuff for Snapshot Image Pros. Again, 10% off your next listing photo for those of you who came to class today. But yeah, if you have any questions, hit me up. I'm going to be doing some sort of class into it. I don't know what it is yet. So if you have got suggestions for things that y'all want to learn, let me know. And then hopefully I will see most of y'all in 2 weeks. Thanks again, everybody. Grab tacos on the way home. You're very welcome. And then Stone Team folks, stay where you are.